So this is going to be covering itemized deductions. So the overall concept here is that the Internal Revenue Code allows some types, and they're set out, and we'll talk about them, of personal expenses to be deducted from AGI. So hopefully you remember from last week the distinction for AGI and from AGI, and that would generally be on Schedule A of Form 1040, and those are the items that we look at when we consider itemized deductions. So remember that itemized deductions, you're basically going to add up all the itemized deductions and determine whether that total of itemized deductions is greater than your standard deduction. And of course, if it's greater, then you're going to want to use the itemized deductions, and you're going to be said to have itemized your deductions versus just taking the standard deduction. Now, there are certain types of people, if you own your own home, being the principal type, that it's generally going to be a good idea to itemize. So as a tax professional, there are certain types of people, low income, students, maybe young families that don't own their own home, and you'll get more familiar with these as you work with individual taxes. But basically, there's just going to be certain situations where hey, it's going to be, before even adding anything up, before looking at the totals of anything, hey, it's going to be a good idea to itemize for these people, or it's very unlikely that itemizing will help. And you see here a copy of a Schedule A that just kind of goes through and sets out the various named itemized deductions. And you can see at the bottom there the option for other miscellaneous deductions, or the second to last section there. But for most of them, the Schedule A kind of sets out and gives instructions on what you need to do to calculate. So it's got the you see there with the medical and dental expenses, it's got the 10% floor already factored into the equation there. So you basically just have to follow the instructions on there. When talking about medical expenses, you'll recall that one of the issues with deductions is they have to be deductions that you actually directly incur the expense of. So this is one of the areas where there's exceptions, and generally it's just dependents or children, as you see there. And you see here just a visual representation of what it takes to be classified as a qualified medical expense. As you go through those, you can see basically it has to be a legitimate medical expense, and where this mostly comes up is where people are wanting to try to deduct cosmetic type surgeries. Unfortunately, if I would like to, of course I don't need one of these, but if I wanted to get a hair transplant, that would not count as a qualified medical expense, even though personally I would argue that it affects the structure or function of the body. But be that as it may, the IRS has determined that any type of item that they would consider cosmetic surgery, which includes hair transplants, obviously plastic surgery type stuff, cosmetic dental work, anything like that. So braces are kind of a tricky one, because sometimes I think generally braces are considered qualified medical expenses because the orthodontist or dentist can make the argument that um, if your teeth are badly enough aligned that it definitely affects the function and structure of your body. But stuff like porcelain veneers um, that arguably only affect the appearance and not the function um, are not considered qualified medical. And as you see here on this slide, similar to what I was saying before, um, it basically has to be to cure some specific ailment. So just general improvement of health and wellness by vacationing in the Caribbean islands. Probably not going to work because not a specific ailment. Um, but if a physician says, hey, you have hypertension or heart disease and you need to lose weight, you're morbidly obese or whatever the case may be, and you have to lose 100 pounds or you're probably going to die, and it's specifically related to XYZ disease, then whatever measures are required to make that happen would be considered. Of course, the medical treatment has to be considered legal, and where this might actually, and I have not seen any cases yet in this area, but where this might come up is, the IRS is a federal entity. You've got specific states that, like California, for instance, that allow medical marijuana. So the medical treatment is legal for the state, but in the eyes of the federal government, not legal. So, like I said, I've never seen that actually come up, but theoretically that could be an issue. Just general like herbal supplements, other stuff that you might get at a health food store that may or may not have specific medical benefits, generally not deductible. If I'm trying to think of an example of this third bullet point, for instance, if you have a specific school for a child with a learning or physical disability, for instance, if you have a child with autism, they go to a special school that, like a private school that is for autistic children, you may be able to deduct. I'm not sure if you would be able to deduct all of the tuition, but a portion of it at least for sure, and possibly all of the tuition for a school like that, where it is specifically for a diagnosed physical or mental. The PC term here is difference. I would say handicap or disability because I don't think, for instance, you being gifted is probably is a mental difference. The IRS is not going to allow you to go to a school for the gifted and pay the tuition. So I can understand the desire to be PC here, but what this generally means is someone with a disability. We already talked about most of these. Basically, again, cosmetic surgery, not deductible, but stuff like eyeglasses, eye exams, dental exams, physical therapy that directly affects the functioning of the body would be. Here's kind of the outline of what types and how much can be deducted for transportation that is considered quote unquote essential to medical care. You can deduct actual expenses for for transportation, for necessary medical care. There is a mileage rate, so if you're driving your own vehicle, that's the amount that you would be able to, as of 2014 tax year, that's the amount that you'd be able to deduct per mile. There's a 50% disallowance for meals, limits to how much you can deduct per night of lodging, and really, I'm not sure where you're going to find a room that you would want to stay in for $50 a night, but theoretically, there's something out there like that. And then again, for that bottom bullet point, this must be a medical necessity, that the patient must be accompanied. So, for instance, if the patient happens to be a minor, then obviously that person would have to be accompanied, and of course there would be other, certain types of physically handicapped people that could not otherwise travel without being accompanied. But just keep in mind that the burden of proof, if that were to come up, it would be on the taxpayer to show proof that that was a necessity, if they're trying to claim that extra $50 per night for companionship. Yeah, this basically, again, is just saying it has to be for medical necessity. But the key thing to remember here is that second part of the sentence there, that no significant personal recreation can be involved. So basically, you can't have a doctor's appointment for a medically, otherwise medically necessary trip to Orlando, that on that same trip you decide to spend 4 days in Disney World. The transportation expenses to get you there would not be covered in that situation because you've blended your medically necessary trip with personal recreation. For qualified long-term care, important to remember, showing in this third bullet point, that you must be chronically ill for that to be able to be counted as a normal medical expense, and included with the rest of the medical expenses, of course subject to the 10% of AGI floor, which again just means that you would take your AGI, take 10% of that, and you could only deduct medical expenses that exceed that 10% threshold for the year. But that's the definition of chronically ill in the IRS mind, that for at least 90 days you cannot do by yourself, basically, at least 2 of the 4 items here. I won't go into those to detail. You can figure that out on your own. And let's see, what else did I not cover here? Yeah, I mean, you can deduct, if you have insurance premiums related to qualified long-term care, those can also be included with the calculation for the medical expense. For capital expenditures related to medical care, generally, like it says there, the acquiring of capital assets for medical in rendering medical care is not deductible with these exceptions. So basically, you've got items that might be considered capital expenditures that relate to a sick person, service animals, artificial limbs, wheelchairs, and basically, they're talking about some wheelchairs that are very fancy, could be several $1,000s. So obviously, that would normally be considered a capital asset. Eyeglasses, I'm not sure that would ever be considered a capital asset, but those can be deductible and are deductible when paid. For service animals, actually, like police forces that use trained drug dogs, consider those capital assets, and they're actually, believe it or not, I'm not sure how you feel about animals, but they are treated or given capital asset treatment, which basically involves all things that you would normally expect, including depreciation per year on the animal. But in this case, you would have a similar, very expensive animal, including all the training that went into making it a service animal, but that would be deductible when paid. If you have items that permanently improve a residence, and these are basically talking about items like a swimming pool that are, or that basically would be useful to raising the fair market value of the residence, even assuming that the next owner did not have the same physical ailment. So this would be like, obviously, a swimming pool is useful and can up the value of a home regardless of who's coming into it. But the example that you see there in number 3 at the bottom, you can have, and I've seen some very extensive modifications to a home to make it handicap accessible. And while those, might raise the value of your home, at least with respect to someone who might be purchasing it who has the same physical ailment, in general, that would not be something that raised the value of your home, because at best, someone else who's not physically handicapped is going to come in and say, yeah, I don't mind that being there, but they're definitely not going to pay you extra money to have a handicapped accessible house if they have no need for it. Whereas a swimming pool is kind of, in general practice, usually considered an item that would increase your fair market value. So that's kind of the distinction that they make. Maintenance expenses, deductible if the original capital asset or whatever was deductible. So obviously, maintenance expense on your pool, since the original nature of the capital asset expense was not deductible, obviously the maintenance to that also not deductible, but maintenance on like the handicapped ramps and that kind of thing would be considered deductible. And since these are all still considered medical expenses, so still subject to that 10% AGI. I think the main item to take away from this slide is just in general, general rule is all living expenses related to living in an institution, assuming that there is some medical need to be there, are so generally, regardless of the method that you're using to account for your taxable income, generally expenses only deductible in the year that they're paid, with the following exceptions. Credit cards in general are just considered to be paid when charged, and as you've seen, we've dealt with prepaid expenses before, only deductible when services are rendered, unless it is required, in this case, a requirement for receiving the care with the medical expenses. So of course, basically the IRS is not going to allow you to deduct something that you later are reimbursed for. So, I mean, the basic idea of a deduction is, hey, we're not going to tax you on some of these expenses that we deem, at least for medical expenses, necessary for your survival. Now, of course, the policy reason for allowing that deduction in the first place goes away if you're already getting reimbursed for that. So basically, in this example is showing someone who likely is deducting a certain amount, not knowing when or if they're going to be reimbursed for it. In that case, the deduction stands, but then when you're reimbursed for it, you end up having to recognize income in the year that you're reimbursed. Now, if you'd never deducted the medical expenses to begin with, then you don't have to recognize a reimbursement because that's not really income. It's just a reimbursement of an expense. So here's a visual representation of the various taxes that are deductible from AGI on your federal taxes. So you've got state and local foreign real property taxes, state and local personal property based on value, state and local foreign income, state and local sales tax if it's an elected tax, and state and local taxes for state and local taxes for trade or business or income. Deductible taxes for AGI, self-employment taxes, and you'll see when we do some of the self-employment stuff why that is considered for AGI deduction. It's basically the same idea of when business expenses are deducted on a separate schedule and then transferred back over to the 1040. When they come back, they're basically, they cancel out income and then the net is brought back over to the 1040. So that's the same basic idea of why self-employment taxes are AGI. This slide is pretty self-explanatory, just showing the calculations for self-employment taxes. There's a 15.3% employment tax on net income, calculated on Schedule C or through Form K1, 12.4% Social Security, subject to that upper threshold there that you see in the bottom bullet, and a 2.9% Medicare. And continuing on here, you see that half of the self-employment taxes are also available to be deducted from AGI on page 1 of Form 1040. You see the additional surtax there for individuals with higher income thresholds, and that the amount there on the bottom. Here again, just a visual representation of the breakdown of what types of interest expense are deductible versus which types are not deductible. I think most of y'all probably know that credit card interest and auto loan interest, of course, not deductible. Same with interest paid on personal loans. Interest paid on trade or business loans, of course, would be deductible on Schedule C or on the partnership forms. Interest paid on mortgage of a home, of course, everyone hears about the mortgage interest expense deduction. Interest paid on student loans, although that's limited. Investment interest or passive activity, also limited. I think we all know basically what interest is, so I won't spend too much time on that. Although notice in that third bullet point there that bank service fees are not deductible unless they are part of a trade. Here's the breakdown of what types of interest expense are for AGI deductions versus from AGI deductions. Again, trade or business, and again, that's because it is calculated on the other form and brought over as a net total of income minus expenses. Then you've got student loans and passive activity interest expense that is also for AGI, and again, that's why those are both limited to some extent. And then the from AGI deductions, mortgage interest, and for these different types of interest expense for an active trade or business, the taxpayer must materially participate. If they don't, then it's considered passive and subject to passive activity loss limitations, where losses have to be suspended and carried over and basically are only allowed to be netted against passive activities. And then investment interest expense limited to net investment income. So again, similarly, if you have more interest expense than you have income, that cannot be used to offset ordinary income. Just a definition of what investment interest expense is. I think most people would probably come to that same definition if you ask just what their general idea of what investment interest expense is. Doesn't include interest on debt to buy tax-exempt securities, which I think we already covered that a little bit in a. These are just some various other investment expenses that are not interest expenses. These are deductible, and others, if you could think of other examples, deductible from AGI on Schedule A and subject to 2% AGI threshold. Basically, these would be considered miscellaneous expenses that were I think no big secret that a qualified residence, you can deduct the mortgage interest. Subject to those two qualifiers there, it has to be for acquisition or home equity indebtedness, so a home equity loan would count as well. And it also must be considered a qualified residence, and there's, of course, IRS regulations or code sections that deal with defining what a qualified residence is. Also, mortgage insurance premiums, but those had to be paid before 2014. And so here's the basic idea of how you determine whether a residence that you own is considered a qualified residence. And first of all, a taxpayer may have two qualified residences. So even if you own 8 houses, only 2 of them can theoretically qualify. So you have a principal residence, and you can have up to one other residence that's considered your personal residence. But that the non-principal residence can only be considered a personal residence if personal use exceeds the greater of either 14 days or 10% of the days that the property is rented at fair market value. So that of course doesn't count like loaning the property out to friends or relatives and them not paying for it. But that also doesn't count for personal use. That would just be a non-counting day. But you would basically count up the number of days that it's rented out at fair market value, take 10% of that, and if that's greater than 14 days, you would use that as the threshold, and if 14 days is greater, you would use that as the threshold. See if you used it for more or less than that amount of time, and if it was for more, then you could use that, or that could be considered another. In order for the mortgage to be considered for acquisition indebtedness, it has to have the residence as security backing the loan. The debt has to be incurred to acquire, construct, or improve the residence, and interest deduction is limited to first $1 million or $500,000 if married filing separately of debt. So, if the house is more than $1 million, then what you would calculate whatever the interest would be on the mortgage of the first $1 million of that mortgage. So if it was for $1.5 million, you'd basically just take 2/3 of the mortgage or the interest payment and say, this is what I'm deducting. So these are other basically caveats or exceptions that would allow different situations for the mortgage to be considered an acquisition indebtedness. So if you acquire the residence within 90 days of the debt, so you secure the loan first, then you go out and buy the house. Or for a construction loan, you have basically a 2-year period to build or improve the home. Refinanced acquisition, so you can basically refinance your mortgage, but it has to be for the principal amount cannot go up when you refinance for it to be considered still part of that acquisition. For home equity loan, you have some limits, so basically you are limited to the less of either $100,000 or whatever equity is in the house. So, let's say fair market value of the house is $300,000. You're wanting to get $150,000 home equity loan, and you owe $200,000 on the home. So basically, in that case, whichever way you calculate it, either using the standalone $100,000 or the fair market value in excess of acquisition indebtedness, you would still get $100,000. So you basically just look at how much equity is in the home. That is, obviously for a home equity loan, you're going to be limited to that amount. But if that amount is less than $100,000, then that would be your ceiling of how much of that debt could be, interest could be deducted from. For that $1 million limit that we talked about before, that's the acquisition debt. But on top of that million, you can still have the $100,000 home equity loan. So theoretically, you could buy a house that has, costs $1,100,000. You've paid down, or your down payment or whatever has your outstanding balance being $1 million, and you're going to take out another $100,000 loan of home equity to do some home improvements. So now you've got $1 million on the principal and another $100,000 home equity loan. Both of those would be allowed. So basically, you don't have to cap the overall house debt at $1 million. That's just the cap for the acquisition side, and then you have that additional $100,000 for the. I think we talked about this in a previous class about when points on a mortgage can be deducted, but these are the 4 requirements. Has to be specified in the agreement. Points are a percentage of the loan, so that's, I don't really call that a requirement. That's just kind of the nature of what points are. Paying points on the mortgage has to be an established business practice in that region. So if it's not common to that area, it can't be done, and it has to pay to secure the principal residence. Again, I think we talked about this a little bit, but if the seller pays the points basically, yeah, I mean, if the seller pays the points, it's considered as if the purchaser did, so the purchaser can actually deduct the payments that the seller made. So that's another, I think that's when we talked about it, that's another situation where you can deduct something that you didn't actually pay for. And again, those are few and far between. that last bullet point is pretty self-explanatory. If the taxpayer refinances the mortgage, um, you cannot immediately deduct points on that loan. They have to be amortized over the course of the loan. I won't spend too much time on this slide. You can just read over these. It's getting a little bit more detailed than I want to get. I don't really have anything in. For student loan interest, like I said, this is capped at a maximum amount of $2,500 per year, and there's a phase out starting at $130,000 if you're married filing jointly, or $65,000 as an individual. Whereas your AGI increases, the percentage of that $2,500 that you can deduct decreases. So, you know, if you do the math, this is not not that big of a benefit. Basically, to have a substantial amount of student loan interest, you obviously have to have a sizable student loan. So this really only benefits someone who has a sizable student loan and doesn't make very much money. But it's kind of not all that big of a benefit for someone in that situation. Here's just a graphical representation of the timing of interest deductions. We'll talk about that a little bit later on. For charitable contributions, you generally calculate the amount that's considered a charitable contribution. Obviously, by cash, you're just going to say that the contribution was the amount of cash that you paid. And then for any property donated, you're going to be allowed to use fair market value. And that last bullet point just says that basically if the charity gives you something in return, regardless of what it is, regardless of what it is, assuming it's not a de minimis item. So if they give you like a bookmark or something, that's probably considered de minimis, but anything that you receive that has any value that you can establish a fair market value on, you would have to deduct whatever you received from what you gave to arrive at to have been charitably donated. This is I'm not sure why they set it up like this. I guess it just looks pretty, but these are just some of the organizations or types of entities that you can donate to that would be considered charitable contributions, with the bulk of those being 501c3s or churches or schools get the most traffic, I guess, in this area. So those are what you'd be dealing with most. Here is a basic flow chart of what how to calculate the charitable contribution. And these rules are not particularly difficult to apply, but as you see, there are several areas where you can, answer yes and no. I mean, I don't want to say it's terribly complicated with respect to taxes, because obviously this is pretty straightforward in the tax world. But I guess my recommendation would be anytime that you are trying to calculate the charitable contribution deduction, something like this, if not this exact slide, being out in front of you to make that flow chart, unless you deal with these quite often, and then of course you'd probably have most of them committed to memory. But basically, you would just follow this flow chart and see that you are often limited to 50% of AGI as kind of the upper end threshold of how much you're going to be able to deduct of a charitable contribution. and there are lower thresholds depending on the nature and character of the donation and of the recipient. So you can use that to work through if you're doing any of the My Accounting Lab work for this chapter, um, or just looking through some practice problems at the end of the chapter. I would just have this sheet out, or the page in your textbook, which I don't have in front of me right now, but that has this flow chart on it, and work through it that way. And you would see after you did, and I'm not expecting to do this, of course, but after you did 20 or 30 problems that required you to work through most areas of this flow chart, you'd have a pretty good handle on what goes where and when. I kind of touched on this a little bit earlier, but basically, you really want, with respect to anything related to tax, you can't really go wrong with overdoing substantiation. So for virtually all tax-related areas, and I say virtually all because sometimes something triggers that puts the burden on the IRS, but generally, the burden to prove something with respect to taxes is pretty much always on the taxpayer. So, of course, you can always weigh the chances of you getting audited and the chances of this even coming up. But in general, something that I would advise clients is to keep as many records as possible. If you have a large charitable contribution of property, you should get it appraised before you make the contribution. If your contribution is mainly or mainly done with the purpose of generating a deduction, you really want to go out and get that appraised. Not saying after the fact they would say, hey, that has no value, but if you get it appraised and then based on that appraisal, that's the deduction that you take, they're not going to just take your word for it. So if you had it appraised and you don't keep the appraisal, and they come back and say, hey, that was appraised way too high, where's your proof? You got to be able to give them something. So again, basic box rant here, but basic idea, always keep everything and keep as much of it as you can. With the ability to scan stuff and whatnot, having an e-copy generally is just as good as having a hard copy, but it needs to be kept somewhere. Like I talked about, there's thresholds for the amount that you're allowed to deduct, the upper end threshold, and then sometimes 30 or 20 based on the items in that flow chart. Any excess contributions over those limits can be carried over for the subsequent 5 years. So there is the possibility of carryover there. Or I'm sorry, any excess contribution over the threshold deduction limits that would force you to have a carryover, those can be carried over. I would say just to remember, in general, the taxpayer cannot deduct losses on personal use property. The exception is in Section 165, dealing with casualty and theft losses. Those can be deducted from AGI, and again, that's going to be on your Schedule A on 10.4. And I showed you that area for miscellaneous itemized deductions. Again, those have a floor of 2%, and basically that doesn't mean that you can throw anything in there that you think is a deduction, but these are basically items that are specifically set out, and we've talked about some of those in this presentation, that are related to some other valid deduction but don't fit squarely into one of the categories, the IRS, basically specifically lets you know, hey, these have to be grouped into miscellaneous itemized deductions. And the problem with those, again, is that there is a floor that they have to exceed in order for those to be considered itemized deductions or deductible expenses. I'm going to be honest here, I'm not real sure what this is supposed to be telling you. I guess those are gears. Um, yeah, so if you get something out of this slide, very good. So again, these are just upper limit thresholds where above these numbers, you start to have to reduce itemized deductions based on filing. And here's the showing the amount that you would have to reduce those by. And that bottom bullet point is basically just telling you, hey, you need to take, you can't use that reduction. Basically, figure out what the itemized deductions would be total. And the last thing that you should do with respect to those deductions is apply the phase out. So you can't apply that before applying any individual reductions within each individual, or individual reductions within the deduction itself, if that makes any sense. So we'll end with itemized deduction phase out example. Robbie's a single taxpayer. He has AGI of $400,000. He has extensive medical expenses. Let's say he incurs $100,000 of medical expenses. He's only able to deduct the amount that exceeds 10% of AGI. So in this case, he had $100,000 of expenses. 10% of AGI is $40,000, so he can only deduct $60,000. Now, when he goes to calculate the reduction of his itemized deductions, he's going to look at the amount he already calculated, so in this case, $60,000, and that's what he's going to apply the reduction based on his income to.